Hey, what's going on? This is Chris. Welcome to Varilla Trading. I hope you guys are doing well today. In this video, I'm going to show you guys 3 live trades that took place on December 15th in the US Treasuries bond market. And because I know that all you guys care about is money, I'm going to first show you the profit and loss on those trades. And I'm going to also explain to you guys why the profit and loss has nothing to do with my future profit and loss. In fact, it's a lagging indicator, and that you should never use profit and loss or equity curves to actually measure your expected value in your trading. There's no account numbers on the screen, but this is a live account. ZFH23 is the symbol. The first trade is a long trade, a short trade, and a long trade. If we look at these trades, you can see in ticks, these would be about a 6-tick winner. So that's 6-tick winner, 6-tick winner, and a 4-tick winner. That was this trading day right here on Thursday. So we're going to look at those trades, and if you look at the max open loss, you can see only the second trade was 1 tick against me, and the other two were zero ticks against me. The first trade lasted 40 seconds, the next one lasted 53, and the last one lasted a total of 3 minutes in lower volatility. And I guess it's been a good year for me. I've learned a lot, and I've become a lot more consistent in my trading. I want to show you guys certain things that I do in my trading. So just stay tuned for that if you're interested in learning about how to trade futures, day trading. Basically, the stuff that I do, it has no guarantee to help you in your trading, unfortunately, because everybody has their own sort of journey. And most of the time, people, when they look at other traders, you can take little nuggets of info from them, but you're never going to be able to do what they're doing. And this is why I believe I can show you my trading from start to finish. You might be amazed at some of the things I show you because you've never seen it before, but at the end of the day, you're not going to be able to apply it anyways unless you sit down next to me and freaking get every little piece of info. And even at that point, you're still going to have to take the time to apply it yourself, which is going to take a lot more time than you think. So let's get to it. Honestly, the only reason I'm showing you the P&L is because I know that all people only care about is fucking money. Unfortunately, thinking like that's going to get you nowhere in trading because the money is not really what matters. Obviously, you trade to make money, but looking at your P&L and looking at your equity curve, in fact, is not going to help you get better. It's a lagging indicator, in fact. That's what I believe, at least. I'll show you some indicators that I made that I think are leading indicators that have the potential to be leading indicators to show, your potential expected value in your trading and where you're messing up and how you can improve. We need to hit the gym, guys. All right, let's get it. Okay, so let's start. I want to first talk about bond trading. And one thing that I've learned that I think is really important. The main thing here, the main takeaway that I want you guys to take away from this is if you're going to trade bonds, most of the time, in my opinion, the best opportunity is when there's economic data. When there's no economic data, what happens with these markets is they become very highly efficient and there's not a lot of opportunity unless you're going for bigger picture plays, bigger swings intraday, or even on a multi-day time frame. That's different. But when it comes purely to intraday volatility, I found that the best opportunity and the easiest trades and the easiest, trade management as well, managing your risk on each trade is easiest when there's more volatility, and that only happens around economic data for the bond market. That's what I've noticed. And I've also noticed by looking at my stats that a lot of times where I'm just sitting there getting chopped up and I have a couple, so-so trades and I'm giving away like 2 ticks, 3 ticks at a time, it's normally because I'm trying to trade during times where there's just not a lot of action. There's just not a lot of inefficiencies to capture. And the worst that can happen is when you're trading in a market like that, you just get stuck in a trade and then you just end up taking a stop and you might even get slipped on a stop. Now, multiply that type of action by, multiple trades per year. That's the kind of stuff that can make the difference between you being profitable and you being break even, or you being profitable or very profitable. So that's one of the realizations I've made about this particular market. And it's also one of the main reasons why I don't really trade them as much now when there's not a lot of data. So the first thing I do before trading any day, guys, is look at the economic calendar. I learned this the hard way many times. And trade around the economic calendar. It's basically the only way to kind of gain context. Volume comes into the market around economic data, so you have to be trading around that. Remember, as a retail trader, you can't move the market. You need to be trading when the market is moving. So if institutions are trading around the economic data, and that's when the big money's flowing in and the inefficiencies are happening, you need to be there and trading that activity pretty much exclusively and stay out of this shit when it's nothing's going on. So just as an example, let's look at today. Today, there was a very limited economic calendar. And let's just look at this price action for today. And this will kind of give you an idea of what I'm talking about. Okay, so let's look at this morning, right? So you can see we had some overnight action, just sort of big trading range. And then starting at 7 in the morning, you can see we have a move down. But if you look at the periods of consolidation and basically, so these are 1 minute bars, okay? Generally, if you look at on average, what's the range of these bars? And you're looking at 1, 2, 3 ticks if you're lucky on most of this, right? Going into 8 o'clock in the morning, and then you have your 8 o'clock in the morning hits 8:20, which is the official, I guess, cash open of the bond market. And we're still pretty much in like 2-tick ranges here. Each bar is basically has a range of 2 ticks. So what that tells me is that there's really not much going on. There's not a lot of activity, and there's a lot of liquidity in the market, which means the market is very efficient. You're not going to have a very easy time looking for, I guess, fast money or any kind of short-term inefficiencies when you're trying to look at a market like this. Okay, so this is the difference between you trading on a day where there's, more people playing the game, more inefficiencies, and potentially some economic data in play, which is causing the market to reprice itself, and it hasn't been fully repriced yet, versus trading on a day like this where there's nothing in the calendar, and you're just sitting there and you're saying, you show up and you're like, you know what, I'm gonna buy it, right? And then maybe something happened for whatever reason, and you just either you got stopped out, or maybe your stop didn't work, and now you're sitting in this trade and you're saying, I want to buy it again. So now you buy 2 of them, and then it continues going this slow, dreadful type of 1-2 tick volatility, and it's just grinding down like this. And pretty soon you're just sitting there in a fucking 10-tick loser, and you're just looking at yourself saying, what the fuck did I just do? I'm just giving an example, right? Because this stuff can happen, and I want to, do my best to share my knowledge with you guys to, potentially give you guys more information so you can stay out of this type of bullshit. So I'm literally telling you that I stick to this market only when it's volatile, or medium at least. Like, I'm looking for when it's at least giving 3-tick, 4-tick rotations. That's kind of like the minimum for me. Now, that being said, I have traded it when the volatility contracts and we're kind of grinding, because there are opportunities for that too. Going into 9:30 here, you had this chop, and then look at this, just an absolute, dead market, okay? So this is what bonds look like when there's no economic data. I hope you guys understand that, okay? Now, if you look at the economic calendar for the rest of the week, there's actually not a lot going on. Tomorrow's Tuesday, not a lot going on, and then it should pick up going into Wednesday, Thursday, Friday. Maybe it will, maybe it won't, but what I do know is that there's some data scheduled for 8:30 in the morning on Thursday and Friday, so keep an eye out for that. All right, so let's go on and look at these trades now. So we're going to look at Thursday here. And at the same time, I'm going to bring you over to the chart, and we'll just kind of look at the context. So let's go over to this chart. I'm not connected to the data feed because I don't need to be. And this was the Fed Wednesday, and this was Thursday. Okay, so Thursday we were basically opening up in the center of the range of the prior day, not the center, but within the range of the prior day. So that's something I always watch for when I show up in the morning, is like, where are we opening relative to the prior day? It's very important, because if we're an inside day, that's really big context, and it can cause, sometimes it can cause the context to be messy. Sometimes it can cause market trends to occur that catches a lot of traders offside, because they're still trading in the mentality of the prior day or the prior 2 days. And sometimes nothing can happen at all. So one thing I was considering on this day was that we could have a potentially lower volatility day than the prior day, seeing as though we had the Fed and we had the CPI the day before. So there was an odds here for volatility contraction. There was also odds for volatility expansion, depending on what we would see. So always considering as many scenarios as you possibly can. Okay, so let's go over to the DOM, and we're going to watch the session. So the session, I started filming here at 8 in the morning, roughly around 8:10 in the morning. And we had data coming out at 8:15, I believe, or something around there. So right away, we see a move down. We see some volatility hit the market. And, just right away, you can see the range of these bars is a lot larger than what I just showed you on today's action. This is a market that has volatility to it. It has opportunity. So you can see that the market is trading lower, and we're forming this new trading range here. And then all of a sudden, it starts to catch a bit of a bid. So basically, it's sold off to around this 9.5, 10 area, and this 19.5 to 20 area, or 18 on the low end. Now, if we go back over to the chart here, I want to bring your attention to this level, because this is the level that I would have been watching. I would have been watching a supply zone that was ended with one-time framing right here, starting at 29.5 on the 10-year. And more specifically, I would have moved that supply zone down to here at this point, because you can see here we have around 4 or 5 bars in a row, and then we have the first bar that closes below the low of the next was right there. So I'll mark the line starting right at 29. All right, and then there's also another level right here, which is important, because you can see we have 1, 2, 3 bars down in a row. Now we're on this bar, and then this bar tried to go higher before going lower. So what this does is it basically brings my level down to here. So now we have 28.5 to 29, and this is a zone of importance. And you can see that it did maintain importance going forward for a few of those 15-minute rotations. Go over to the 5-year chart and we'll do the same exact thing so you guys get the hang of this. Again, we have this move up here, multiple bars in a row. The first time the market closed below the low of the bar was right there. So that's where I would have marked my line. And on top of that, you can see we have these 3 bars in a row once the 15-minute rotations have changed to the downside. We have this up bar, and then we have the next bar here, which did in fact trade higher than the high of this bar, but it ended up closing lower. So actually for me and my principles, this marks a 15-minute zone right there at 15. Okay, and you can also see again the same thing. That 15 level was a support zone going forward for later in the day. Okay, so now that you understand the context here, the market had sold off and then it rallied up from these, I guess, these demand zones. It breached the low, it traded down to about 9s, and then it started a rally up. So I was watching the rally up, and this is what it looked like pretty much. So you can see the market is trading higher back to 13s, and it just continues higher for a few minutes, and we're going up to 1475s. And again, it's continuing higher, and we trade all the way up to 16s. Still not really interested in this at this point. I mean, to get on the long at this point, you're kind of chasing it. So what I did was I waited around a bit for a few minutes, and then I saw this. So right there, we have a complete auction down at 15, and we can watch how that happened if you want. But basically, 15 to 16 is that zone that I just showed you on the 5-year. So we go through it on the upside like that. All the way through with this big move up. And now what we're going to see is the market trade down to 15. And how it trades at 15 is interesting. So we have one contract that goes down there, another one, and that's all. And then it goes bid at the next price, pretty small bids piling up, but the offers were pulling away, basically. So at the same time, 28.5 was also the low end of that same range on the 10-year. So we have those levels on the 5 and the 10 where they're sort of lining up in the same area. So we bottom tick those areas, it goes bid. And again, this could set up a long right there. For if you're more aggressive, that could set up a long. So now we'll watch how it continues to trade. And I guess at this moment is when I started to pay attention. So at this moment right there, you see it's going to trade 15 another time. So we'll watch it. And we trade 28 on the 10-year. Only one went through. And I think it traded 2 again, right? So it traded 2, and you can even see that on the top right of my screen. It traded 2 contracts there. So what that is, it's a double complete right on the support zone. And at the same time, we have sort of some poor resistance up. I'll go back to the chart and kind of show you that. If you do look at this structure from the prior day, you can see that there is some sort of poor structure here, and the resistance is all the way up to about 1775, which is a big poor high resistance that goes all the way back as far as, I guess, the second week of September. Believe it or not, that level is relevant still in the bond market at this point, because it was an untested resistance that we tested during the CPI report last week, and then we pretty much top ticked it here, and it's acting still as resistance. Contextually, being below that area is very important, because above this area, there's basically just a big single print. There's nothing actually there. So if it were to continue to maintain above that area, that would pretty much be a red flag for the bears to stay short. But if we're below that, that can potentially act as a supply zone to sell into. So what we're seeing is basically the market held those 15s and those 16s. So that's basically what I'm playing off of at this moment. So I'm looking at the trade here. I'm looking at the chart, and I'm saying I'm going to buy it, and I'm going to potentially put my stop right below 15, because if it goes back to 15, there's a reclaim right there. And if it does trade through 15, it's probably going lower at that point, and I definitely don't want to be long. So the trade in this case was basically you buy it for as the best price you can buy it, and your stop is underneath 15. Because on a double complete like that, good chance if it trades it again, it's going to go through it again. You don't know that for sure, but you know, odds are tipped in the favor a little bit. So at this moment, I'm looking at it, You might see me put in a buy stop here before we enter the trade, a buy stop above near the top of the range at 1675. But then I realized upon watching this market, I realized that, well, if I don't think it's going to 15 again, why don't I just buy it here at 1575 or 16s? That way I can have a lower risk entry. And if it does stop me at all those 4 ticks, whereas if I'm buying it up at 1675s and I'm risking all the way to 15s, risking all the way to 15s, the risk is a lot higher on that, and it's going to be definitely skewed. So we see a big buyer come in, and I guess that kind of brought, some interest, and it just made me look at it a little more. I guess that was the moment where I decided to buy it. So right after that big buyer came in, I was hovering my cursor over 15 because I knew that was the area that it shouldn't reclaim. If it did reclaim that, I'd be pretty much wrong. So we see them print 100 into 15.5. It goes bid. And, the buyers are being pretty aggressive. I was watching this for a few minutes. And again, you did see that buyer pull up there for a minute. And they just pretty much took a lot of the offers. That's some pretty aggressive buying. So I'm looking at this now and I'm saying, well, I think I need to buy it here. So I submit my bid at 16. My stop's appearing there at 15 because our volatility is around 4 ticks a piece. I do get filled at 16 in this case. 68 contracts go through on the bid. And we have a relatively small bid, and it just pretty much stays bid and goes bid at the next price. And we'll watch how it trades here. So we're going bid. We have a big trader that bids it up at 16 halves. And I can tell it's a big trader because the average lot size is larger. And also there was a higher percentage of orders that were above the average lot size. When it lights up blue, that's basically what it means. It's just a quick way of seeing if it's larger orders that are making up the bid or smaller orders. And it's interesting to see, like, if you're, betting on a move and you're seeing a big trader bid it up, it tells you that someone's willing to push the market up, or someone's wanting to push the market up, I guess. So then you want to see how is the market reacting to that, right? So if a big trader submits some big orders, is it going away from it? In this case, it's going away from it. So that's a really good sign for the trade. The trade's working. In this case, it's just going straight up. And again, the big resistance that we talked about, 1775. But basically, I'm playing off of volatility approximately in that range. I'm not going to put my order right at 1775. I'm going to put it basically 1 tick before it in this case because it lines up with where we were previously trading, which was 16, 16 and a quarter, about 6 ticks away. 4 ticks accounting for overshoot was about 6 ticks, 6 to 8 ticks potentially. So I did get filled on that offer up at 17.5, and that was the end of that trade, right? So, fine, we'll take it, right? We had 4 tick risk, we made 6 on it. That's perfectly fine. The market did continue up for a few more ticks after that. But, trading a 1 lot, you guys know the scoop. There's limits to what you can do. So the market trades up there for a little bit, and then we see some sellers come in and the bids pull down, and now we have a new wave down that starts here approaching 9 in the morning, and we're not quite there yet. We're 8:51 in the morning at this point, and I do place an offer up at 18 and a quarter. Now, I guess we can talk about why I placed an offer here. So one of the main reasons, I think, is because if we are now selling off below that big reclaim, that big CPI September level reclaim here, on both the 10 and the 5, because it was right at 2.5 to 2 on the 10-year. And I know I spit out levels fast because there's so many of them you have to pay attention to. We're selling off from that. There's a big reclaim down like this. And I'm thinking, well, okay, well, if we did go up there, there's probably going to be some traders trapped. So you want to maybe look to sell this on a pullback. But there's also a chance that if we do reclaim 1775s that we could see some more upside too. So it all depends on how long these things take to play out. If we do start seeing the slow grinder action where it's grinding its way up like that, that sort of makes the trade a lot more dangerous to take, actually, to short this. But in this case, the risk was relatively reasonable. Let's just go back to the moment where I actually placed the order. And you can see that when I did place this order, the market was trading down here at 1675. That's where we had traded the most volume. You can also see that right there on the top right of the screen on the footprint chart. Okay. So basically, my order in this case was placed based on 1675 to 16.5. That's sort of the range that I was watching, I guess. And you're looking at 4.5 ticks with overshoot up to about 18.5. I put my order basically in the middle of this range, which was 18 to 18.5. And that's pretty much it. In this case, the stop again, a measured move away, which would be about 4 or 5 ticks in this case. But judging on how the order is filled, I might choose to manage the trade differently, meaning I might probably try to cut it if it's going against me. Normally with these types of trades, like a fade type trade entry like this, actually this is more of a V trend entry, which is a volatility trying to enter on the back of a trend, a new trend that you think is formed. In this case, what we had is a stop run up, and you only knew this was a stop run up because we have this big move down after reclaiming all of it. So that's what increases the probability that if we do get up here, we could probably see a lower high before we see a higher high. I guess I'm giving you guys a bit of narrative. So that's it. My order is still up there. And 4.7 ticks volatility, and then the market's shooting up like this. I mean, this is interesting. So let's watch the market shoot up from this low. I'll fast forward at 30 seconds above there. So we're 8:53 in the morning at this case, which is still good. And we're going to talk about 9 to 9:30 right after this trade, because that's another game in itself, okay, especially for bond trading. So the offers are getting taken, and it's going up relatively easily here. You see it doesn't trade much there. It trades the next price. 17s, goes bid. 17 and a quarter. Now it's stuck at 17s for a bit. Still bid. They're taking the offers and it's holding the bid. So there's someone willing to push this market way up at this point. And it's going up really fast to the point where people look like they're chasing it. They're not getting filled. I'm up here at 18 and a quarter. My range is still there, which is interesting. Meaning it's printing as high as 18 and a quarter at this moment, but I know that it could overshoot. So in this case, I do get filled at 18 and a quarter. And I did clear the current trades very quickly there as soon as I got filled. But basically what we saw is the market swept up to that 18 and a quarter, traded about almost 500 on the offer, if you saw it very briefly there. And it did trade some on the bid. You can see exactly what printed there right there. The delta was 335, 617 traded, 46 traded at 18.5. Okay. So let's watch it now, okay? So we have 5 lot offers at 18 and a quarter, 5 lot offers here, mostly small lot offers. We're not seeing big traders show up on the offers yet, but we want to see how the market trades up here, which is interesting. So it slams up another time there. That was really interesting right there, okay? And that's the type of noise that you have to get used to dealing with, in my opinion, if you want to learn how to trade these markets properly, because that can happen a lot. You see how it just swept like that? Maybe that'll scare you out. If you're used to reading another market, that type of sweep that we just saw there, that might scare you out of the trade. Well, it didn't scare me out because I've seen this trade play out a number of times that I know that you have to sit through that type of noise. So after it did that, it kind of got stuck on the offer there at 18, and now it's printing on the bids on the downside. And also, same thing on the 10-year. I was looking mostly at what was happening on the 5-year, but we did get stuck at 2 on the 10-year. And then we were filled on our bid down at 16.75. So that was that range play right there in front of 18s to 18.5s. Stops would be above the highs, basically. Not looking for it to go further than that. The fill was extremely fast, which was very good for this trade. Like I said, if we would see a slow grind up and lower volatility, that trade would have been a lot more questionable, and we would have probably had to accept a little bit more heat on this trade. In this case, I know it looked almost like a perfect trade, but I want to inform you guys that most of the time it's not going to be like that, because there's so many factors that go into this, and a lot of times you're going to have to sit through maybe a couple of minutes of that back and forth. I do, at least. And those 2 minutes extra of back and forth, it gives you a lot more information about the likelihood of your trade working out or not. And also there are scenarios where you just have no idea what is going to happen. That can happen too. And you just simply have to, keep your stop in there and keep your target in there and just wait for something to happen. That can give you more information. So that was that trade. All right, guys, we're going to look at the last trade from Thursday, December 15th. Believe it or not, I just filmed the whole review and it wasn't recording. So give the video a triple like for a double review. It's going to be 2 times better than the first time because I already did it. So let's do it. Okay, first things first, market context. So let's go over to the chart for Thursday again. And at this moment, guys, the market was going down. So what the chart looked like was that. We were basically in this downward rotation and we were trading, I guess, towards the support zones of the prior day, which we had already bottom ticked. By the way, that was already the low of the day. So this would have actually been a red line at this moment. The first time we were going down there, this would have been a green line like that. And then as we tested it or within the region of it and then moved away from it, at that moment it becomes a red line, which means I still categorize it as a level of significance, but I also increases the probability that if we get there again, it can flush through it a few ticks. So I'm not really gonna play it on a first attempt. Like I'm not gonna basically put an order right there. It gives me a signal that that's an area that I need to be watching, but I'm not gonna put my order right there waiting for the market to get there. I'm most probably gonna trade on the backside though. So in this case, that's kind of what we did. So the market's going down. We have this rotation to the downside. This is a 15-minute time frame. And on the 10-year, it looked like this, where our support zone was at 22. So 22 was a support zone on the 10-year. And if we do look at the 2-year, there was pretty much nothing there. There was nothing in that market. And on the 30, again, there was nothing. The 30 was pretty bullish, just kind of sitting in this little trading range here. So the 5 and the 10 were the ones that had sort of the most context, which is always good. I like it when there's kind of less context but clean context rather than having so much context everywhere, and there are days when that happens and it's a little kind of complicated to work through. So those are the levels. We had that 1099. Okay, so let's go over to the screen recording and watch it all play out. Now one thing that's really important is after that second trade I showed you guys, we're going into 9 o'clock in the morning, and my stats tell me after quite a lot of occurrences that the majority of time I'm not making money from 9 to 9:30 in the morning trading this product ZF. All right, and that's kind of something that just blatantly stood out to me. So I just, generally I need to be kind of, step off the gas pedal a little bit during that time period. And lately it's been going pretty well because what it's told me is that I'm over trading during a period where the market doesn't really have the opportunities that I might be looking for. And on most days, that's pretty apparent because it's kind of 30 minutes right before the stock market opens. On this day, we did have some chop during this moment. Doesn't mean that it's always going to happen, but statistically, if it's showing me that that's a period where I'm not making money and I'm giving back profit, it's probably going to be a period where I need to be fucking avoiding it as much as possible. So, that's what I do now. So the market does chop in this trading range here, and we start with a new rotation down. We're trading in this trading range, and I'll fast forward the session a little more. The stock market opens and the volatility is contracting. Now we're trading, at 3-tick volatility approximately here. And I didn't really see anything that I wanted to execute on at this moment. What happens is we go all the way down to the 9 area, which is pretty much where the prior level of support was on the 5-year. We have a big bounce from that area, which is interesting. And then we slowly reclaim all of it and then go for a new low. So you can see I put an offer up there in the case that it did get up there. That was interesting, but in this case, the market didn't get there. So we won't have to look at that. So the market goes down for new lows, basically. It goes to clean up the lows of the session at this point. And we're still an inside day of the prior day. It's important to know. And we have this new trading range that's forming below that 9 area that I was just showing you guys on the 5-year chart. If you look at 22s, though, we're right around 22s in the 10-year, and that's where the same level is on the 10-year. The 5-year and the 2-year were underperforming the curve, and the 10 and the 30 were more bullish, okay? So we have this new trading range forming here, high of the range, 875 to 8s, okay? We've already reclaimed 22s on the 10-year, so that's bullish, but we still don't have enough information to execute on anything. So I'm continuing to watch this here. Now, we do have a bottom tick of 22 of one contract, which is interesting, and it's trading 22s, completing, and then trading, going bid, and then trading at the next price. So that's one bullish sign right there, and I'll keep fast forwarding it. It goes bid, 875 here bid on the 5-year. Still not enough information. It slams down again. Okay, so now we're down in 8, and again we're trading at 22 again. This is 2 minutes here in the future because these are 1-minute bars. We're trading at 22. It's completed at 22, in fact. I'm not sure if it's going to trade on the offer, but I'm watching it nonetheless. And 22 is exactly where that reclaim is on the 10-year, and 9 is where the reclaim is on the 5-year. So we're complete at 22 at this moment. I know it doesn't show that on the chart there, but because I was watching it on the DOM, on this back tick here, we're complete at 22. So pretty bullish in this moment, and I'm looking at this and I'm thinking if it does go to 9s, based on how we came 1 tick shy of it twice in a row like that, I'm thinking that it has the potential to go through and continue, maybe go back to test those 10s again. So I put my buy stop condition there, and I'll tell you what the buy stop condition does. You can see it says 104 on the side there. What that is, it's a percentage of the liquidity. And basically, if this offer here drops below 104 or 104 or less, it is going to submit a marketable limit order at this price that I have it set at. A marketable limit order is basically a buy limit order. In this case, it's going to be a buy limit order to buy at 9 when the condition is true. If there's no more offer left by the time my order gets sent, it's just going to end up being a limit order at 9. All right. That's in the case that my order just doesn't submit fast enough. But most of the time it submits and I get into the trade. Sometimes it doesn't, but we'll watch what happens. So again, we traded at 8 down there, and then it's kind of coming back up. 171 on the offer. So what I'll do is I'll bring it back a couple seconds, and we'll watch how it trades up there. Again, it did trade on the bid at 8. Center of the range is 8.25. Our volatility is saying 3 ticks, and at the same time, the 3 ticks is lining right up with the reclaim at 9. So that's all kind of lining up together. So I put my buy stop at 9 in this moment. You have 500 on the offer there. 300 now, 275. Some of them are pulling away. And 171 print on the offer. And then my order gets triggered right there. As 268 of them printed, my order got triggered right there. Now my stop appears at 8. That is pretty much where the stop would have been. There's nothing wrong with that. I think that's just fine. Because I am betting on the fact that it is about to reclaim 9. It's a bit of an aggressive entry, but the other context is lining up with that. So the offer got cleaned up. Now we're bid. And then it goes back offered very briefly. And then I clear out the current trades. So if you saw very briefly there, about 40-something contracts printed on the bid. And then it went offered over 225 contracts at 9. Okay, so only 40-something printed on the bid, 200-something traded into that offer at 9. 49 go through on the offer again. Only 4 go through on the bid. You see that? And they're printing the offer, and it's pulling. So remember, there was 200 or something, only 68 trade, and the rest of them are gone. So what does that tell you? That offer was full of shit. It was just an offer. A trader submitted the offer, high frequency trader, just to kind of spoof you out for a second to see if they could get anyone to sell, and then boom, they pull it out. As soon as some of the offers are starting to get taken, they pull the rest of them out and they go bid. You don't know if that's the case, but it really just tells you that the seller wasn't really that confident in selling right there. And so what happens is the market traded on the bid, and then they took the offers and they pulled the offers up. So we're going bid now, 9 to 9.25, 9.5 trading here, and we'll keep watching. All right, so we're in a good trade at this moment. Upon the entry of the trade, everything has gone well so far. We have our reclaim at 9, and we'll just continue to watch, and I'll continue to run you through what I'm seeing here in this moment. So we're trading up at 975, and one thing that I am considering is that we're in a much lower volatility condition at this moment than we were when the session first started. So we're printing on the bid here at 9.5. And what this means about the lower volatility is that the management of the trade is going to be different. Sometimes you might need to give it a few more minutes, a few more extra seconds, just to kind of go back and forth, a little more noise. The more efficient the market is, the more noise there can be before it's moving and as it's moving as well, from what I've noticed with these markets at least. So what I don't want to see, I'll explain to you, is the market to kind of snap down, the bids just kind of disappear into thin air. Those bids at 9.25 to 9 just disappear in thin air. And then we're offered over at 9 and we're printing 875, going offered over at 875, maybe printing on the offer about 500, 600, 1,000 or whatever, and it just can't get through it. That's pretty much a red flag at that point. I might stay in a couple extra seconds, but no, as it's doing that, it's like you're pretty much working out for a 1-tick loss if it's going to try to do that. If you're lucky, you'll get it. What I do want to see in this case, what I will allow for is it to come back and test 9 again, because 9 is exactly where that reclaim is. And the more efficient the market is, and as the volatility is contracting, the market is becoming more efficient. It's getting back to its efficient state where there's less opportunity. The more likely it is that it has to kind of revert every pivot before moving. So I will allow for that to occur in this case. So now let's watch the noise here for a few minutes. And again, I'm not always actively analyzing it, but breaking it down like this does help me to read it better in the future. And potentially it also helps you guys to see these things on your own charts. So we traded 6 contracts at 9. And now there's a trader taking the offer at 9.25. Okay. Their bid there, it's a pretty small bid. Only 10% of the orders are above the average lot size. And then they're still taking the offers at 9.25 there. So they're buying a lot. There's a lot of buying going on at 9.25. And there's still more buying. You see that? Still more buying. They bought more than 1,000, I think. And then they print at 9.5. And if you look very closely, again, that is easy to miss what we just saw. There was 100 that went through on the bid at 9. And as soon as that happened, the market snapped up 2 ticks. And that's very important information. So we'll watch that occur again. Right there. You saw that? And the bid almost went to a very small amount of contracts. There was almost as if some traders wanted to buy at 9 that they just didn't want to get filled. So we have small lot bids. Only 12% of the orders are above the average order size. What it does is it prints 100 on that bid, and then it doesn't look back. So it completes on the bid right at the price of my reclaim, in this case, and then it goes bid. So that's good information for this trade. That's basically kind of a green light that continue going, go to the next stop here, because it looks like we're going in the right direction in this case. So that's good information. We don't want to see it go offered over at 9. We really don't want to see that. If it does go offered at 9, there's a good chance it goes offered at 8.75 too. In that case, we're pretty much ouch. Like that's an exit and a re-entry. But in this case, it's not looking like that as we print up to 9.75 like that. And 118 go through there at 9.75, and we're in a pretty slow market. You can see it's kind of going back and forth a few ticks. The volatility is contracted, and I'm contemplating this at this moment. And I do always understand that there could be the potential for a bigger rotation to capture, and there have been a few trades I've caught like that on a one lot too. But most of the time, as we can see here in this case, the session is kind of tapering off. It's 10:36 in the morning. The volatility is contracted quite a bit. I'm pretty much looking for a scalp. Like, I'm not really going to look to play this on a bigger rotation, even though I understand that there is a probability that we do have a bigger rotation on the 15-minute time frame back through the range. I still don't know if it's going to rotate this red area here, this red block. It'll just rotate it, chop, and then come back, and I'll just not get filled if I start being too greedy with it. So I put my order at 10 and just to look and get a 4-tick scalp, which I think is reasonable considering the volatility is contracting, and I don't know if we're going to see more of it. So I'm basically playing with the information that I have in front of me. I'm playing on the chessboard that I have in front of me in the context of the game that I'm playing, which is a one-lot trading game in this case, which I bought it at 9 and I sold it at 10 in that case. Now, you could say, it could be argued that I could have been a little bit more patient, like a couple of seconds more patient to get slightly more efficient prices. But even if I did do that, I had to be there with the mouse like a fucking ninja waiting, because like, look at that. You see, I traded up to 10.5. Let's say for whatever reason I had my order at 10.5 and I didn't get filled. I would have been trying to chase it out to get out at 10.25, and now it's going to 10, going offered at 10. So it would have been trying. That's what the market does. It fills them, and then it tries to get people to chase it, and then it goes the other way. And it's just, I'd rather be paid on my measured move than fucking chase the market around, chase the HFTs around as they pump and pull the bids and offers. It's kind of an annoying game to play, in my opinion. So, understand your playing field. So I took the 4-tick scalp in that case. All right, guys, that's going to be the end of this video. If you enjoyed it, thank you for watching, and I will see you in the next one. Take care.